Hi everybody, my name is Alexandre Kech. I'm the CEO and co-founder of Onchain Custodian. We are an APAC Singapore-based custody and open finance service provider, and we offer the absolute safe for digital asset holdings and investments. Onchain Custodian is continuously working on solving the digital asset trilemma of security, convenience, and compliance. In June, we are talking about this trilemma with industry leaders, and this is our last session about compliance. While you are going through their bios, let me introduce our panel today. With us, Sian Jones, Senior Partner at Xreg Consulting. Bharath Vellore, Managing Director, Asia Pacific at Accuity. Laura Chaput, Head of Compliance at Keyrock. And Mriganka Pattnaik, CEO at Merkle Science. Let's start. Welcome everybody. Thank you for having accepted my invitation to an on-chain custodian invitation to this panel on compliance. We will start by asking each panelist to briefly introduce who they are, for what company they work, and what is compliance for them. Starting with Mriganka, maybe?
Yeah, sure. Hey, Alex. Thanks for having me on the panel. I'm Mriganka, one of the co-founders and the CEO of Merkle Science. So Merkle Science essentially provides blockchain transaction monitoring services to law enforcement agencies, regulators, blockchain companies, as well as financial institutions. In terms of my background, I think for the last 3 or 4 years, I've been in the cryptocurrency industry. Before Merkle Science, I actually worked at Luno, a Naspers-backed crypto exchange across Africa and Southeast Asia. I think that's where I was responsible for business expansion in Asia and got a very good perspective on how banks and regulators think about this industry. And I've actually seen it change firsthand over the years as well.
Okay, thank you very much. Maybe Sian, do you want to be next?
Hi there, everyone. Sian, and I'm a partner at Xreg Consulting. We're a group of former regulators of firms in the virtual asset space who have now moved on and become policy and regulatory advisors both to the public sector, governments and public authorities, and to the private sector, to VASPs and others. We're based in Gibraltar, although our reach is global, and I've been in the blockchain space, I suppose, now for about 7 years, and have worked in a number of roles in the UK and public policy in Brussels, and in Gibraltar, working for the regulator, where I also then sat as a delegate on the FATF Policy Development Group and some other working groups in standards too.
A topic that we will probably talk about today, I'm sure.
I hope so.
So Laura, do you want to go next on the introduction?
Yes, of course. So hi Alex, hi everyone, and thank you very much for organizing this interesting panel. I'm the head of regulatory compliance at Keyrock, and prior to Keyrock, I was consulting at PwC. So Keyrock was founded 2 years ago, and we are market makers. So we have developed our own algorithm to provide liquidity to digital assets. So we serve 2 types of clients, the exchange platforms and the issuers of assets. And typically the pairs on which we will operate are either crypto to crypto or crypto to fiat.
Thank you. And last but not least, Bharath.
Hello everyone, pleasure to be on this panel. I am Managing Director for Asia Pacific region for Accuity. Accuity is part of Relax Group. Specifically, our business focuses on financial crime screening, which is screening your customers, transactions, payments against watch lists, could be regulatory sanctions, identifying politically exposed persons, or even screening against law enforcement lists, as well as adverse media databases from across the world. This is one of the businesses that we're in. We also are on the counterparty KYC side with our Bankers Almanac brand. I've been with Accuity for 9 years now. and in this space providing screening solutions to banks, financial institutions, and now to virtual asset service providers for the last 12 years. Yeah, that's my experience.
Thank you so much. We have a lot of experience on this panel, and I really appreciate your presence today. So let's start with the first question that I have for you. So maybe can you share, you're from different geographies, so we have Europe and Asia Pacific present, but also different aspects of the business. So can you share in your various geographical and business context what regulations and compliance considerations are you focusing on for the moment with regards to digital assets? Maybe we can start with Sian.
Oh gosh, well, I guess if I tackle geography first of all, as I mentioned, I'm based in Gibraltar, and Gibraltar was one of the first jurisdictions to bring in a dedicated and specific regulatory regime for crypto. Back in 2015, governments sat down with the private sector to understand whether what then was really just cryptocurrencies, whether they would be something that the jurisdiction, which is a small jurisdiction, but is you know, a financial center on the southwestern tip of Europe, whether the jurisdiction could be comfortable with this new technology and with these new instruments. And after a couple of reports, it decided that it was something that could be managed, and set about introducing a regulatory regime that was really equivalent and parallel in some senses to the traditional sector, traditional finance, but at the same time allowed for something that was still in flux to be properly regulated. And so instead of defining different types of instruments, which is the traditional way of regulating financial services, it looked at really those who were responsible for other people's value, for effectively value that was stored in some way, shape or form using DLT, but that belonged to other people. So you could think about this in a very broad sense of being kind of custody. If you had any kind of custodial responsibility for other folks' crypto, then you fell within this regime. And this was a principles-based regime, which really allowed for the regulatory environment to develop as the sector and the products and services evolved. And that came into force on the 1st of January 2018, so it's been running nearly 2.5 years now. There are numbers of licensees for what are called DLT provider licenses, and it's been a pretty successful outcome both for the industry and also for consumers and investors, because they know that they can trust DLT providers in Gibraltar. So something quite different and quite novel in its time. Certainly Gibraltar's been a pioneer, and I guess this is really something that other jurisdictions are now slowly starting to follow in one way or another. More broadly, I'm involved a lot with AML CFT matters, as I'm sure we'll talk about later on. I've been one of the co-leads of an initiative to develop a particular standard, and before that I sat on ISO's technical committee for DLT and blockchain, so that's the International Standardization Organization. And I suppose out of all of that, the AML CFT piece right now, following the introduction a year or so ago of FATF's broadening of its scope, of global anti-money laundering guidelines to cover the whole of the virtual asset space and virtual asset service providers. That's been the largest focus of the work that I'm currently involved in. And that really is everywhere in the world. For reasons that I'm sure we'll talk about later on, it's something that's applicable and will become applicable for those places that have not yet applied this widening of scope, anti-money laundering scope, will be something that applies in every jurisdiction in the world.
I think specifically within AML, as in with digital service providers, we've been seeing KYC as an increasing focus, especially since the FATF guidance came in last year. We've seen a lot of interest geographically within this region. Singapore, Japan, these are the markets which have kind of taken the lead. The players in this market have taken lead to ensure that they are really benchmarking themselves against the rest of the regulated financial industry. Very, very high kind of volume of interest from these markets specifically. But other than that, we do see players coming in who are speaking to us from Australia as well. We have customers who work with us based out of Malaysia as well. So we have kind of, as an, it's not just specifically around just exchanges. We have Onchain, which also uses our services, being a custodial service provider. So it's across the spectrum. We even have had wallet providers who are working with us on KYC. But KYC is where at least our discussions have been focusing a lot on. That's the subject matter right now, which is, at least from whatever we've been discussing from a compliance point of view, seems like that's high on the agenda.
So I mean, you have companies like Accuity who have been in existence way before crypto in a way and servicing the traditional banking industry. And we have new companies in this space, Mriganka, Merkle Science. I guess your agenda items are similar, but with a different start and perspective.
So I think that's exactly like a good way to describe what we do. Like the older generation companies like Accuity and maybe Refinitiv, and now like with cryptocurrency, there's a new challenge that's emerged is you also need to do AML CFT specifically of your cryptocurrency transactions. So make sure the wallets that you receive funds from are clean. They're not from, say, a ransomware address or a darknet address or even the US OFAC list. Similarly, a lot of the transaction monitoring that used to be done in traditional finance now needs to be done, not just on like off-chain transactions, but also on-chain transactions. So that's pretty much the domain Merkle Science deals with. So the AML CFT, but for cryptocurrencies on like a blockchain level, basically. And at least in terms of considerations, like Bharath mentioned, for now we were Asia focused. So Singapore, Japan were definitely forerunners, but Southeast Asia as well in different parts have regulated cryptocurrencies and have a license in place. Hong Kong is also an exciting geography now where they've come up with like an optional licensing. In my experience, all these geographies, especially Singapore, has actually put forth very detailed guidelines, not just for traditional transaction monitoring, but even for cryptocurrency transaction monitoring, where they've actually laid out a few types of risks that you should watch out for, specifically laid out categories like ransomware, darknet marketplaces, as well as you know, the variety of other activity that we look out for. So all in all, it's been quite exciting. And what's interesting is that the space has evolved very rapidly in just like the last 2 years. Like since when I worked for a cryptocurrency exchange, while a lot of these guidelines were there, it was more best practices, at least in Asia, rather than like a compulsory must-have. Whereas now, like almost every regulator in the region has come out with specific guidelines, come out with detailed like limits and detailed guidelines on what to do about this space. So that's pretty interesting on our front. And I think like this is happening world over, of course. So as we do a soft expansion to markets like the UK and Switzerland, I think the UK's FCA has incorporated the 5th AMLD into their legislation, into their money laundering regulations as of Jan 10th. And yeah, I mean, as we grow larger and as the industry grows larger, I think this will become a part and parcel of running a cryptocurrency business.
Well, as an entity running a cryptocurrency business, Laura, Keyrock as a market maker, what are your what prevents you from sleeping at night, if anything, in this space? Is it the change of, is it the new regulations coming in, or is it understanding the existing regulations? What keeps you busy for the moment?
So yes, so Keyrock is based in Belgium, and as the other panelists said, the first regulation introducing obligation for crypto businesses based in Europe is the 5th Anti-Money Laundering Directive. So all member states were supposed to transpose the directive by the 10th of January 2020. However, very few of them are compliant, meaning that the same business would not be subject to the same requirements from one EU country to another. Belgium is one of the countries that haven't yet transposed the directive. So as a consequence, Keyrock is not yet regulated by our local supervisory authority, and today there's no other regulatory requirements for businesses active in digital assets. This being said, at Keyrock, we are committed to conduct our business with integrity, and therefore, as from the start, we have decided to be proactive and have already implemented AML CFT requirements, and we have based them on the highest standards across all EU jurisdictions. So AML is the first compliance consideration, and the second one is, although there's no regulatory requirements, our objective is to build a fair and transparent market for all participants. And therefore, we follow the market abuse regulation. So we're not allowing any kind of insider dealing, unlawful disclosure of inside information between employees or outside, and any kind of market manipulation. So AML and market abuse and conduct are the two main concerns.
It's a very good introduction for the next question. So we do see that regulators are definitely catching up and coming with new regulations, or including digital assets into existing regulations, like the Payment Service Act, for example, in Singapore. You illustrated it very well that before that, the industry had to kind of self-regulate it. I'm myself co-chairing the custody working group of the Global Digital Finance, where we come up with code of conducts in absence of regulation, in a way, on how we should conduct ourselves. Now that the regulators are catching up, do you think that they're catching up in the right way? And maybe I'll start with Sian, who is an ex-regulator. Are they doing that in the right way, or what challenges does these new regulations bring to the industry, and opportunities?
That's a mighty big question, Alex, because if you were to ask the question 5 years ago, what the risks and the harms were, you would first look at the types of tokens, the types of coins, their function, and try and understand how they work, drawing analogies with the traditional financial services world, and then look at some of the activities that are being performed, and then, in a sense, policymakers would try and target the harms and the risks with regulation. I think it's super important here to make one thing clear. Regulators very rarely make the rules. Most of the time, the rules are set initially by policymakers, and those evolve into laws. And so legislators, lawmakers, are the ones who bring in those rules. And regulators are the folks who then have the job of acting on those regulations. And it is a huge challenge for policymakers to understand new sectors. There's no experience, or very little experience, to go on. But for most jurisdictions, policymakers are looking at, what are the harms that can be done to consumers and investors, what are the risks of using these instruments and performing these activities on them. So with that said, I said, where you asked the question, where are the challenges for the industry? And the challenges for the industry is that this industry grew up, in a sense, largely in unregulated space. That was indeed part of its attraction. And now that regulators are understanding crypto better and have evolved regulatory regimes to address those harms and risks, the industry is in a process of catch-up. I recently on a talk referred to this industry as sort of growing up and is now really at the stage of puberty, where it's starting to suffer the growing pains as the reality of adulthood approaches. And I think that this is a challenge for any industry, because if you're small and you've been able to operate relatively unfettered by regulation, you haven't had the costs, of course, of compliance. And suddenly, with new regulation comes a whole array of compliance responsibilities. And even if you're a business that wants to be compliant, that wants to operate, as Laura mentioned, with integrity, even if that is in your DNA, you're still going to face a load of compliance challenges that you then have to implement and you have to suffer the cost of. And if you're a small player, and this industry has a lot of small players, if you're a small player, then those costs and burdens can be disproportionate. And I think that probably is one of the biggest challenges. Regulation affects us all in one way or another. If you drive a car in a particular country, you're either going to have to drive on the left or the right. Someone set that rule up. It might not make a lot of difference as to whether it's the right or the left, but at least everybody knows where they need to drive. And really, financial services are not an awful lot different. Crypto is not a lot different. And you get you just have to accept that that's part of doing business. But introducing costs part way into a business, introducing complexity part way in, is without doubt challenge. Now, before I finish, I'll also turn to a part of your question where you said, are regulators doing it right? Well, I'll slightly modify that question. Have policymakers set the right policies and address them in the right way, addressed, if you like, those risks and harms in the right way? And, I would be bound to say that sometimes the urge to not give preference or priority to, say, incumbents versus newcomers, or newcomers versus incumbents. There's a sort of imperative of creating a so-called level playing field. And sometimes that belies the benefits of innovation and fetters it. And I really think that over time, regulators will meet the challenge of having to make regulations that were really designed or modeled around old traditional, shall I say, financial services, applying those approaches to something that works quite differently. And that actually creates challenges for the regulators to implement, and additional burdens and challenges for those who participate in that industry.
Bharath, I saw you nodding at that, and I guess that's from your experience from both incumbent and new businesses. Can you add anything to this?
Yeah, absolutely. Especially to that last point that Sean made. I completely echo that. I think it's that understanding of this industry. I think there are certain elements which are different in APAC to what Sean has said. As in, it's not necessarily policy makers who are driving this here in this region. Regulators, at least the culture of how regulators work in APAC, there's a bit of hand-holding which is involved. Regulators do issue out guidance papers here, which is something which is completely unknown in, say, USA. It never happens. You see a lot of guidance papers here. There's a lot of kind of engagement with the industry. Initially, there's that examination of what exactly are the risks that this has come up with. So to that effect, I think regulators have done well. But I think where they could do much better, and I know I'm saying this on a panel and talking about regulators, but still, I think something which I see as some it's a gap, and I think we'll have to kind of, as a sector, the entire industry has to come together to address is the collaborative part of it, guiding those regulations and guidances. Regulators, it need not necessarily be completely up to the regulators to educate themselves about the industry. It's up to the industry also to kind of collaborate with the regulators. I see that missing, as if you look at where the kind of the incumbent regulated financial institutions are, they're all very well represented, and they have their channels through their kind of associations, through their kind of roundtables that they kind of regularly have, and everything. The different forums through which they're very well represented, and they have a very good channel both into the regulators as well as policymakers. I see that missing in this industry, and that leads to so many assumptions around how this industry could work, and also bringing in kind of regulations or even kind of expected processes which would work for the kind of more brick and mortar businesses, bringing them as is into this space, which like it needs a mindset to kind of say that, hey, we need to address the risks around, say, money laundering, terrorist financing, but the solutions need not be the same, right? And then the solutions could be very different. This as an industry, to Sean's point, right? It's an industry which is innovative by the basic nature of it. So they could actually bring in solutions which could be kind of completely different from what the banks and other financial institutions have been working with for the last few years. And that can only happen if there's a constant dialogue, where the industry also kind of gives the feedback that you mentioned these risks. This is how it works in our kind of businesses, and this is how we are kind of engaging and coming up with solutions which address these risks. And with that, I think you would come to a space. I know Mriganka's business is kind of very much an example of how solutions could be very specific to this industry. And we have an innovation team which is also kind of is working on how our screening solutions can be kind of, it need not be the same way a bank would deploy it. Our screening on a ledger, on a distributed ledger, could be very different, and we're trying to kind of explore that as well. But I think these are the ones which the regulators also kind of have to be made aware of. I don't know how much dialogue does Mriganka's business have with the regulators, or how much does he have that kind of access, but that needs to happen more. So that's an area they can get much better at.
I was going to ask regarding exactly that. I mean, your solution is aiming at providing a solution to a problem that we have in our industry, which is understanding where the money is coming from in a way, and making sure that we're not participating without us knowing to illegal activities, for example. How is the dialogue with regulators on that specific topic of chain analysis or analysis of transactions on the chain? Because there's this discussion of how many hops do you need to go back to see that a transaction is tainted. All those topics have been happening in the last years. Are regulators now aware of how it works and conscious that solutions can effectively help prevent money laundering, for example, in our industry?
Sure. So I'd probably be better at giving a perspective from our standpoint rather than from a cryptocurrency business. The treatment to them might be slightly different. But at least in our experience, we've found that dialogue as well as reach has both been relatively easy, as we're a RegTech provider. And even in terms of the content, like when we present to them the questions they send back to us, or the clarifications they ask for, we often find that regulators and law enforcement agencies tend to like ask us the best questions, like even from a technical perspective, or so that just goes to say how much thought is put into any sort of opinion paper, even an opinion paper that comes out, that they've actually studied all the different tools out there, all the different problems. And in our experience, and at least in Singapore as well, they talk to like every segment of the industry, like starting from even like 2-3 member teams to right down to like the bigger exchanges, and definitely give them like some time or like a platform where they can express themselves, ask their questions, and even answer a few clarifications that like the regulator might have. And I thought that this was actually unique to maybe Singapore, because Singapore is known to have some of the—
Singapore is an exception, Mriganka.
yeah, but like to like my surprise, I found out that this is actually happening all across. Like our way of reaching out to a financial regulator is just looking up the person who's written up the opinion paper and cold emailing them. And then we like very often do get like a call. Like at least earlier I was under the impression that this would have been a more rigorous or a more detailed, more difficult process, but it's quite simple this way. So I think even in terms of the way different geographies, like every country has its own limitations, which is why speed is an element. They can't come up with their own version of like guidelines for crypto asset businesses as quickly as some others can. But I think that at least the policymakers or the regulators who are studying it are definitely aware of all the implications, and their job is not just to make businesses easier, right? Their job is to make sure that like there are these types of risks, and they need to find a way to de-risk that. So from that perspective, I actually have a contrarian view, where I feel that at least world over, there's the movement that like more or less regulators are starting to understand and even move forward with like regulations that will help the industry rather than detract from it. And we even see like I think there's a general trend of like the slightly younger person within that institution being allotted to the cryptocurrency division, just so that they understand the tech better or they understand issues better. So yeah, I think that would be my opinion there. And I think while a lot has been covered on like how regulators are dealing with it, the other part of the question was challenges as well as opportunities that I think Sian as well as Bharath didn't cover as much. So challenges, of course, compliance costs increase. And of course, there's like with the different types of regulations, there's privacy issues, there's cybersecurity risks, like with the travel rule, how are you going to deal about it? But I think hand in hand, that actually comes with opportunities. So for a very long time, like banks and traditional like institutional investors have shied away from cryptocurrencies. But as there's more and more regulatory clarity and compliance requirements for the industry, we'll actually see a lot of them like taking an active interest, where rather than let's explore cryptocurrency as being their mandate for the year, it's actually that we want to get into this segment and let's find out how. So they're being a lot quicker into enter. And I think this, again, Alex might have experienced this firsthand, but even for B2B institutional businesses, I think a larger portion of the financial services industry will start actively engaging with crypto with the cryptocurrency industry now that there are more regulatory requirements in place. And even I would say for retail, like retail cryptocurrency exchanges, which are the biggest losers of additional compliance costs. So at least for me, like in my experience, there have been lots of friends of mine and lots of like relatives who actually come out and ask me, you know, is cryptocurrency legal, or isn't it very risky? Isn't it is it not regulated? So so now with all these regulations and requirements coming about world over, maybe in the next 5 years, there would be this other segment of retail, the older generation, the slightly more conservative section, that will also come into like investing in crypto assets, because now that they know that there are like licensed players, they can actually trust their money into these investments.
Quite interesting. What I would understand why a regulator would want to talk to you guys on both Accuity and Merkle Science, who are providing solutions to their problem. But is it the case as well for industry players, Laura? Do you talk often to the Belgian regulator or European regulators on or lawmakers even or is it more complicated to get a meeting? And then we'll go to the next question and the next chapter on the FATF recommendation.
That's a good question, and Keyrock is very transparent with the local regulators. So we have a constant communication with them. And to answer your question, is regulators really catching up? I would say that in Europe, definitely. I believe 2020 will be a pivotal year for the cryptocurrency industry. There has been, I would like to highlight 3 recent regulatory initiatives. The first one is from the Commission, who opened a consultation. It was opened between December 2019 and March 2020, where all citizens of member states could respond to questions, and the objective was to understand how to regulate crypto assets. So the Commission is working on a legislative framework, and they said it would be published in Q3 2020, which is actually just around the corner. There's also another initiative regarding AML. It's again the Commission, and they published an action plan and a consultation to reform the framework. So there's also a consultation to open. They're open to comments. So indeed, they're trying to really get the views from all member states to understand what are the loopholes and how to better regulate the market. So I would say that the big opportunity of new regulation is to address the current compliance loopholes, such as unclear regulatory framework, the fact that there's no taxonomy with clear definitions of each crypto assets. There's no one single rule within Europe. So there's regulatory arbitrage between all member states. And also, I believe that regulation will improve the current negative image of businesses related to cryptocurrency.
Sounds all good then. I'm kind of hearing that, yes, regulators are catching up, sometimes with some issues here and there, but and maybe probably harmonization between regulators.
It's a lengthy process of consultation and legislation.
Yeah, but at least they are listening, or at least want to understand and do what is best for the consumers in general, which is good. Maybe let's look at a specific piece of recommendation in a way first that will be translated into regulation, or is being translated into regulation, which is the FATF recommendation 16. So Financial Action Task Force is giving recommendations to its member states on how AML CFT can be prevented through a certain number of recommendations. And recommendation 16 is about transporting information about beneficiary and ordering customer from one sender of crypto to another crypto. This is not new, obviously. It's been around for years. I used to work for SWIFT, so I know that banks have been transporting that information seamlessly over the SWIFT network for the last, I don't know, 20 years maybe. But the crypto industry doesn't have a SWIFT, right? It is decentralized. The blockchain itself is not able to transport information. So this is definitely a challenge that I have as a custodian. So let's talk a little bit about the travel rule and the impact it will have on our industry. Starting again with Sian, maybe can you talk about the industry groups, and I'm merging 2 questions at the same time, that are currently looking at this, that we should be paying attention, us as listeners or watchers of this program, and participate to ensure that it's properly done. And also, what's your views on the impact it will have on the industry?
Right. Well, if I may just clarify one point first of all. The Financial Action Task Force is a global standard setter, and it sets standards for, in effect, some 205 countries around the world. So pretty much every country, every jurisdiction in the world is governed by FATF's AML CFT standards. So it sets those global standards for anti-money laundering, countering terrorist financing. Those rules, those standards are referred to as the FATF recommendations, and that sounds fairly innocuous, but in fact, the recommendations are in effect binding on all 200 plus countries. And so those countries have to implement the FATF recommendations in national legislation or regulatory frameworks. And in a particular sense, you can think of the FATF recommendations as being a kind of baseline. So that means that countries may gold plate or extend their national legislation beyond what is prescribed in the recommendations. So far as virtual assets and virtual asset service providers are concerned, FATF brought in a change that in effect took the existing 40 recommendations and applied them, or made a clarification that applied them to virtual asset service providers all the way back in October 2018. So it's actually been a requirement for a year and a half now for countries to apply these FATF baseline standards to their national legislation. The problem was that this crypto stuff was so different and so new that it took another 9 months or so for sufficient supporting information in the form of a binding interpretive note and a whole set of guidance, which applies to countries rather than VASPs directly, that made it then possible in practice for countries to implement that. And those were published nearly a year ago, so June 2019. Since then, countries have been rapidly assessing what they need to do. Some 20-odd jurisdictions have already implemented it, in some cases because they already had sufficient regulatory frameworks so they could just issue their own guidance or clarifications. In other cases, they've introduced or updated existing legislation. And in other cases, they've started to develop their policies. But even so, probably only around 10 to 15% of countries around the world have yet tackled this inclusion of VASPs into the world of the AML-CFT regulation. The recommendation that, well, the totality of all of this is quite impactful beyond just the travel rule. For example, it's a requirement for every country to license or register all VASPs and so on and so forth. And there are a set of other key requirements as well as some quite small but nevertheless nuanced requirements for VASP when the national legislation applies to them. This recommendation 16 is actually wider than just the travel rule because it also covers obtaining information about one's clients, either when they start to do business with you or in the event of what are known as occasional transactions, when those transactions are worth $1,000 or 1,000 euros or more, although it is up to countries to choose lesser amounts, indeed could apply it to all transactions. So this is really implementing a requirement for KYC, knowing your client on all VASPs. The other facet, which you've highlighted, is the one that's most problematic, which is this travel rule. That is also part of the of recommendation 16, and that says that certain verified information about an originator of a transfer of value and about the intended beneficiary of that transfer is required to be sent by the originating VASP to a beneficiary VASP. And these rules about transferring or transmitting this information only apply where there's a VASP at both ends. So it doesn't apply to peer-to-peer or VASP to end customer. It only applies where there's a VASP involved at both ends. And that itself presents a huge challenge because you've got to know whether, for example, for a particular Bitcoin address, whether that address is associated with a VASP or not. And so what we're now seeing is a range of technical solutions to help VASPs, and they're probably somewhere in the order of around 15 or so projects in development. Some are more advanced than others. Some are already partially operational. Some are still in early stages of development, but there are around about 15 solutions being built to help VASPs in addressing some of these challenges. Those challenges could include discovering whether an address is associated with a VASP, and if so, which VASP and where, but also in then helping transfer the information, because as you rightly point out, blockchains typically don't have inbuilt inherent mechanisms like SWIFT does for payment instructions to transfer this required information. And so there are new technical solutions that have to be built to facilitate the transfer of that information.
Quite a job.
If I may, I would like to react to Sian's answers. So indeed, I have the impression that the regulators are trying are applying a rule that has been designed for the traditional banking industry to an industry that has different characteristics. And blockchain technology provides a public record of each transaction, which makes the use of cryptocurrency not the best choice for criminals. But I believe there's also some positive aspects of implementing this rule, such as, for example, enhancing the audit trail. It will, of course, reinforce the trust of institutional players. And I believe it's necessary to build a strong and safer industry for the long run. So it comes with compliance costs. I'm not sure it's totally adapted to our industry, but I also see some positive aspects to it.
A necessary evil, as we say. And Mriganka, on your side, so I'm guessing you are involved, or at least looking at how your solution through partnerships, etc., could be helping as well, maybe on Accuity side, helping your customers. Can you share a bit on what you've been working on, or at least participating to in terms of industry groups around the travel rule?
Yeah, I think at least from our perspective, we definitely see the FATF travel rule being a very important piece for cryptocurrency regulations going forward. One good thing, of course, is that like since the FATF does, like every country almost, barring like a few, are members of the FATF. So with the FATF guidelines, most countries around the world at some point will implement these guidelines into their AML CFT norms. And regulatory arbitrage would probably stop in the industry, right? So that's definitely something we think that might be valuable in the longer run, because at least from our analysis, we always see that, like, well, earlier a lot of money, like cryptocurrency laundered or cryptocurrency criminals used to like liquidate their funds on exchanges. As exchanges become more regulated, start having KYC and blockchain monitoring, now we see it moving more to like payment processors. But having like an overarching like travel rule which applies to all these segments, of course, helps in like reducing like anti-money laundering as such. And in terms of our adapting to it, well, we're going to adapt to it in two ways. So in terms of like the technical infrastructure, we're actually going to partner with the various providers out there. So we're going to be fairly neutral in our approach, but I think there are three major players that we've seen that have gained some traction. So we will allow our customers to choose which ones they want. So that will help them with the FATF travel rule implementation. But the second part of it is a large part would require, like whenever there's a rule that's implemented like the FATF travel rule, you'll actually see like a plethora of tools as well as criminals coming out with like a variety of ways to flout the travel rule. So we're going to implement a bunch of custom rules on our end to try and like detect when there is, like when the FATF travel rule is potentially being flouted. I think Alex on our last panel mentioned, right, like about how exchanges are thinking of just sending it to private wallets just so that they don't have to comply with the FATF travel rule. So trying to come up with rules and heuristics to detect such activity so that we can flag it out to like our exchange partners as an FATF travel rule violation. That's how we're adapting to it. Yeah, but I'm quite interested to hear how like Accuity is planning to deal with this as well.
So, question to you, Bharath.
Again, let's be in all honesty, right? As in, travel rule is not easy even for the banks.
Yeah.
Even with all that they have, it's not even easy for the banks. So it's wire transfers. So in wire transfers, even as in the way the banks work right now, how much do they know about the beneficiary of the payments that you're making? The beneficiary, is actually has an account with a bank, if it's a cross-border wire transfer in another country, right? So travel rule works when it is globally adopted. Right now, when they make transfers, banks are doing with a certain degree of confidence, and that is where they have this Wolfsburg questionnaires on the counterparties that they do transactions with, just to get the confidence that the counterparty bank has equivalent AML KYC procedures and systems in place, and that gives them the confidence that, okay, we are only working with a certain kind of counterparties who have those in place, and with that we are making this kind of facilitating this wire transfers, because the beneficiary information for the originating bank who's making the transfer for its customer, it's not enough for them to make any decision on the risks associated with it. They can keep an audit trail of the transaction. So travel rule, it's not easy even in the current sense of the word. So I can completely imagine that the challenges will be kind of different and even bigger for a new industry like VASPs. And from my experience, the solutions could be very unique to this world, but it'll only work when it is global in nature. When it is something which translates, as Sean said, there's a lot of work to be done. FATF guidance is not just recommendation 16. FATF guidance was bringing in the virtual assets service. So FATF has this 40+2 recommendations. FATF's guidance was to bring in VASPs and how do they work across these different recommendations. Recommendation 16 was just one of those, which was talking about wire transfers. What is more important for the industry from the guidance is the part talking about licensing these VASPs, having the risk-based approach and how they monitor these VASPs in each jurisdiction. So if it gets adopted, this guidance, the way regulators have adopted the other aspects of FATF's recommendations and translated into law, if they do that similarly on this guidance, that is when there would be certain kind of uniformity and standard set around how VASPs would be licensed, registered, regulated, and with that standards, it'll become easier for you to then comply with the travel rule, because then you would know, okay, this VASP is registered with this particular jurisdiction, this is the procedures and process there, then you would be able to kind of then have the processes around to comply with that. So travel rule it's not singular in nature. Travel rule will only work when it is kind of the entire ecosystem kind of fits into it.
If I may just come back on that, I mean, the points you've made there are absolutely correct. So the challenge is a so-called sunrising challenge, the one of how do you apply it to everybody at the same time, when countries, of course, make their own national laws in their own ways, in their own time. The way that the FATF, you can think of FATF as being almost like a treaty organization. So all its members and the members of its related organizations, so covering pretty much every jurisdiction in the world, are bound, they're committed to implement these rules. The trouble is they can't all do it all at the same time. I think Laura mentioned early on the problem in Europe, where we're very used to a harmonization, and yet there are different interpretations in different member states, and that presents all sorts of challenges. This problem is then magnified globally, and you're quite right. Any of the regime, not just the travel rule, but any of this new regime applicable to VASPs, is only as good as it working across the globe. It took banks a number of years, or it took, I should say, countries a number of years to apply the original travel rule to banking and other payments, cross-border payments. And this will be no different. It will take a number of years before all countries comply. So a lot of what you're referring to there is this sunrising challenge and this disparity, but eventually that will be a global norm, and there will be no choice. Every VASP will be licensed or registered in its own jurisdiction, possibly in more than its own jurisdiction for reasons that I won't bore you with now. And it will have to carry out its KYC on its own clients, whether they're beneficiaries or originators. And the information that flows with the as a consequence of the travel rule is really there only to support two things. It's to support the ability for the VASP at the other end to carry out its sanction checks. And secondly, that information can be made more rapidly available to law enforcement and other investigators. That's actually the purpose of the travel rule. Now, you could ask questions about whether it's a sledgehammer to crack a nut. You could raise valid questions about whether it's whether the overhead of implementing the travel rule is worth the benefit. But that is what is done in the traditional financial services world, and there isn't anything fundamentally different about other forms of value transfer, including cryptocurrencies, crypto assets generally. I would agree with Laura's point that it might well be done differently, more effectively, and I have yet to find anyone who would disagree with that. But no one's yet come up with something that can assure that preference isn't given to either the incumbents or to the newcomers. And so what you inevitably end up with is everything being brought down in a sense to the system that is currently in force.
Well, I guess we will all agree on the higher objective of all this, which is preventing money laundering from criminal activities and financial terrorism, right? I'm just going to ask you for your final word in one sentence about our panel today, and maybe what you hope to see for the future in terms of compliance and digital assets, starting with Mriganka.
Sure. So I think overall it was something maybe that I said before, that like, of course, these additional compliance requirements or additional regulatory requirements come with like a lot of caveats and ambiguity, but I think it's a step in the right direction, because this is what will actually lead to institutional adoption. This is where the cryptocurrency segment will actually be considered a large portion of the financial services industry, rather than them being considered separate as what it is right now. And in the longer run, it'll help, I mean, while it might lead to some smaller startups having difficulty starting their cryptocurrency business as such, in the longer run, it'll also help in terms of creating brands that you can trust, like what Coinbase did in the US. We would ideally see local exchanges all across the world doing that, because now that they have these regulatory clarifications, they can actually be proactive and establish themselves. And also, as everybody there thinks of it from a business perspective, it would actually lead to the pie becoming much larger, as we see banks as well as institutional investors coming into it. So I mean, there will of course be some complications, and there will be a period which is more like the puberty phase of the industry, but of course the end result should obviously be positive.
Bharath, do you want to add something?
No, I think it's been just over the last 2 years, when initial interactions with this industry started, when they were mostly self-regulating, to now when there is kind of definitely better regulatory kind of interactions, guidance papers coming in, FATF guidance is coming. So it's definitely, it's going in the right direction, as Sean kind of mentioned correctly, and that this is a sunrising industry, so it will come with that bit of ambiguity, initial complexity, but that's all part of the growth of the industry. What I would kind of really hope for is, as I mentioned before, that the innovation that this industry has the potential to bring in, that is allowed to thrive in. We could, as in we've been, like with the financial services, we've been doing things one way. Now there are alternatives. Similarly with these regulations, we've been doing certain way. There could be alternatives. Really, really keen that innovation kind of is given an opportunity to thrive as we're going in this direction. But great discussion today. I really enjoyed being part of this panel.
Thank you, Laura.
Yes, I also really enjoyed the discussion. Thank you very much. Maybe to summarize, yes, I really think European regulators are catching up, and they consult with all member states and the fintech industry, which is very good. It's a lengthy process. These discussions are difficult because of the evolving situation of digital assets every day, every month. New players, new coins are coming up. So it's challenging, but it's going in the right direction, and clarity and harmonization can only benefit the market.
And the last word would go to Sian.
Oh my goodness. Well, I think better regulation, especially if it's smart regulation, better regulation applied universally is definitely going to facilitate this crypto industry to become more mature. With better regulation also comes a level of legitimacy and confidence that institutional players can have in the underlying instruments and the products and services that are being offered. The traditional compliance objections to crypto, because it was different and either not regulated at all, or much less well regulated, or less clearly regulated, has impeded the growth of the industry, and the industry will undoubtedly benefit in the long run from increasing institutional involvement that will flow from it being regulated in similar ways to those incumbent industry. So yes, it's going to represent some pain and possibly some contraction, some mergers and acquisitions, some consolidation, but equally it will also stabilize the industry to the point where it can now become is now becoming, I suppose, more respectable, more trusted, and therefore will spur its growth. Thank you very much for inviting me on. I hope our insights have been helpful to your viewers and listeners.
And that's it for this panel on compliance. I do hope that effectively you enjoyed the discussion. You can still ask a question in the chat, but I cannot finish this panel, which is the last of our series, without thanking our panelists and the attendees. Having these industry leaders talk about security, convenience, and compliance has been a blast for us. We hope it was for you. If you want to contact any of those speakers or Onchain Custodian, feel free to send us an email to contact@oncustodian.com or visit our website oncustodian.com. See you at a conference.